Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew Robinow, and this week we'll be unpacking four major stories. From Amazon's £40 billion show of confidence in the UK to growing concerns over capital gains tax, stalling manufacturing output, and a surge in institutional demand for Bitcoin. There's a lot to get into, so let's get started. Amazon is making a £40 billion investment in the UK. It's one of the biggest single private sector commitments we've seen in recent years. Now, the headlines are mostly about jobs, 2,000 of them at each new fulfillment centre, including planned builds in Hull and Northampton, plus two more in the East Midlands by 2027. But this isn't just about warehouses. Amazon's spending cuts across infrastructure, creative industries, and digital services. It includes redeployment of Brave Film Studios and a significant expansion of cloud infrastructure through UK data centres, part of an £8 billion chunk within their wider plan. Both the Prime Minister and Chancellor have called this a massive vote of confidence in the UK, and they're not wrong to make the most of this, especially as it comes with commitments around wages, skills, and regional distribution. Amazon CEO Andy Jassy went out of his way to point out that the investment is UK-wide, including Wales, Scotland, and Northern Ireland. The line is doing some heavy lifting politically, and it's clearly designed to ease concerns around regional inequality. But while tone from government is celebratory, it's not all positive. Ongoing criticism of Amazon's warehouse conditions hasn't disappeared. A new investigation is looking at how it treats its suppliers. Even so, Amazon doesn't throw around money lightly. If they're betting on Britain, it suggests they see a long-term economic potential. Government is ensuring the benefits go beyond the Amazon supply chain and into wider industry and infrastructure. In contrast to Amazon's expansion, UK manufacturing is in a retreat. A new CBI study shows a 23% drop in output across the sector over the last quarter. 15 out of 17 subcontractors have reported a decline, including chemicals and mechanical engineering. Now, the reasons aren't new. Weak domestic and global demand, higher employment taxes, energy costs, and a Brexit fallout. Rachel Reeves' new industrial strategy has a long-term focus on clean energy and advanced manufacturing, which is positive. But right now, manufacturers say that they need short-term action, particularly around energy support and more flexible tax rules. Training and immigration reforms are part of this strategy, but they'll also take time. The next few months will be critical to see who benefits from proposed subsidies. Some of these could knock a quarter off energy bills, and that could make a difference. CBI Chief Economist Ben Jones put it clearly. He said the government must dismantle barriers to growth with real urgency. That means action on energy, digital tools, and reforming the apprenticeship levy, not just proposing new plans. Manufacturers are watching closely. If the government moves too slowly, output could drop further, and some companies may hold back investment altogether. So, capital gains tax is under the spotlight. The previous increase from 20% to 24% for higher rate taxpayers is already having an impact. And now there's talk of it rising again. But there's a risk here. Most CGT revenue actually comes from a very small number of people. In the 2022 to 2023 tax year, just 2,000 individuals were responsible for 37% of all gains taxed. If those individuals delay sales, restructure assets, or move capital abroad, CGT revenue could even fall further. In fact, that's already happening. Receipts are down 10% this year to $13 billion. Back in March, the Office for Budget Responsibility warned that the previous CGT hike might blow a £23 billion hole in the government's forecast. Tax experts are now calling CGT an optional tax. You only pay it if you sell, so raising rates too far might encourage people not to sell at all. The Treasury says its focus is on economic growth and not just taxes. They've pointed to planning future reforms aimed at boosting GDP, but if CGT goes up again in the next budget, we could see a shift in investor behaviour that actually shrinks the tax base. This is a classic Laffer curve situation. Raise taxes past a certain point and revenue starts to fall. The government may need to think twice before pulling this lever again. So now to digital assets. Bitcoin is having a strong run. Spot Bitcoin ETFs in the US have seen 11 straight days of positive net inflows, with a £58 million spike on Tuesday alone. The bulk of that came from BlackRock and Fidelity funds. In total, over $2.2 billion has been flowed into these funds in just under 2 weeks. So what's driving this? Well, one trigger, of course, was the recent ceasefire between Israel and Iran. It gave markets some relief and helped Bitcoin to rise from a low of £77,000 to over £84,000. But it's not just about price swings. Bitcoin is increasingly being treated like a hedge, just like gold. Not everyone is convinced this rally will last though. Ray Youssef, CEO of No One's, called it a relief rally and expects Bitcoin to stabilise between 80,000 to 85,000 in the near term. He also warned that macro signals still carry a risk. It's worth mentioning that there's a split forming within the crypto markets. While Bitcoin ETFs saw strong inflows, some Ether-based funds struggled a bit. Grayscale's Ether fund, for example, saw 27 million in outflows. So while Bitcoin is strengthening its role as a digital gold, confidence isn't evenly spread across the crypto space. But the broader trend is clear. Institutional money is flowing in, and investors are treating Bitcoin as a more stable long-term asset in a time of political uncertainty. There's a clear contrast forming in the UK economy right now. On one side, Amazon's investment brings optimism. On the other, traditional sectors like manufacturing are under strain and capital taxes are being hit at a point of diminishing returns. At the same time, digital assets like Bitcoin are gaining credibility as investors look for safe havens outside of the traditional markets. The next few months will be telling. Decisions on tax, tech infrastructure, and industrial support could tip the scales towards recovery or stagnation. That's all for today's update. Thank you very much for listening to the GCV Weekly Briefing. I'll catch you next time.